Hello, welcome back to my channel. So previously we have learned about the financial statement of the company. In that we have learned each and every point of balance sheet which are entered inside of equity and liabilities and asset side of the balance sheet. So now today we will start statement of profit and loss. As we know that profit and loss must be calculated by each and every business organization or the company to know their profitability, or the main aim of the business is to earn maximum profit. That can be calculated only with the help of profit and loss account in case of sole proprietorship and partnership firm. But in case of company, the profit and loss can be calculated with the help of only statement of profit and loss. So we have to learn this statement of profit and loss, how to prepare it, what are the sequence of writing all the transactions. In this video, we will learn about this in deep. So statement of profit and loss is also prepared in the same way as balance sheet is prepared. Means the statement of profit and loss also have 4 columns. One is for particulars, the not number, current year amount in rupees and previous amount in rupees. First of all, we have to calculate revenue from operation. Now, what do you mean by revenue from operation? Revenue from operation means revenue generated from operating activity of the business, or we can say net sales. Now I am telling you about net sales. What do you mean by net sales? Net sales is equal to sales minus sales return, and sales includes both cash sales and credit sales. So revenue from operation is net sales, or net sales is equal to sales minus sales return. The sales may be in cash or may be in credit. Both will be considered. Second is other incomes. Other incomes means when we do a business, then we have certain transactions which are out of our operating activities. Like we have furniture, fixed assets. And if they are not in use, then that will be sell out in the market, and the amount received, or if they are sell out at a profit, then gain on that assets is known as other income. Clear? Now after we have to add all this to other incomes, also include interest earned. For example, the company has invested money in purchasing shares or debentures or other companies, and they have invested in partnership firm. They have given the loan, and on that they are getting interest. So that is also included in other incomes, because that is the earning, but out of operating activities. So in case of revenue from operation, both incomes are to be included. This will comes at total revenue for the organization or for the company for a particular period of time. Earning profit depends upon revenue, and it must deduct expenses out of revenue. Only getting the amount is not sufficient. When the company is getting amount, it means they have to also pay amount to any other person in another form, that are known as expenses. So out of total revenue, we have to deduct all the expenses so that we can calculate profit. So expenses include, first is cost of material consumed. Now what do you mean by cost of material consumed? Cost of material consumed means the cost of raw material which is used during the year. But it is not compulsory that the goods are purchased or raw material is purchased during a particular year is utilized during the proper utilization of that raw material in that particular year. There may be some raw material which can be left after using all the activities. So cost of material can be calculated is equal to opening stock of cost of material plus purchases of raw material minus closing stock of raw material. Means consumption during the year can be calculated with the help of opening plus purchases minus closing of raw material. And the amount which will be calculated with the help of this formula has to be written here. Second is purchase of stock in trade. Now there is a difference between cost of material consumed and stock in trade. Stock in trade means purchasing of finished goods. If finished goods are purchased by a company for the purpose of reselling, then that will be entered in purchase of stock in trade. Clear? We are taking the example. For example, paper is purchased by a company. And if the same paper is sold out by the company, then it is finished goods. There is no further production. That will be entered in purchase of stock in trade. But if the paper is used for producing notebooks or registers, then that paper which is purchased will be termed as cost of material consumed, means raw material. Is it clear? Next is purchase in inventory of finished goods. Change in inventory of finished goods. Change in inventory means change of stock of finished goods, means opening stock minus closing stock. If opening stock is more than closing stock, then the amount will comes in positive form. And if opening stock is less than closing stock, then the amount will comes in negative. In the same way, work in progress, stock in trade. Work in progress means utilization of raw material in the process of producing finished goods. That can also be calculated with the help of opening stock minus closing stock. Clear? Next is employees benefit expenses. These are the expenses which are incurred by the company for the welfare of employees. Means paying salary, paying wages, leave encashment, bonus, etc. Suppose we have written here employees benefit expenses, note number 1. It means we have to prepare notes to account, and they are prepared in the same way as we have to prepare in balance sheet. Means it has two columns. First is particular and detail rupees, amount in rupees. For example, in case of employees benefit expenses, we are paying wages. Then that will be included in direct expenses, wages. If we are paying salaries, it will enter in indirect expenses, that is salary. We have learned about wages and salary. How can we classify it into direct expense and indirect expense in 11th standard in chapter financial statement or final account. Okay. Now other is leave encashment. Leave encashment can be entered on both the side, depends upon mode of payment. In the same way, bonus can be entered in both the side. Now I am explaining how they can enter in both the side. First is leave encashment. Every company or every business organization gives some particular leave to the employee. For example, if once in a month or twice, 2 leave in 3 months, depends upon the policy of the company. If the company has given the policy of taking 1 leave with pay in 1 month, and if any employee didn't take that leave and the company paid that amount along with the salary or along with the at the end of the month, then it will be entered in direct expenses. But if the amount is paid at the end of the year, then that will be indirect expenses. In the same way, bonus can be treated as direct expense or indirect expense. But the total amount of all these expenses has to be written here as current year's amount in rupees. Next is finance cost. What do you mean by finance cost? Finance cost means the amount which is spent for taking loan, advances, means it is the amount which is spent for raising funds for the company. Now I want to tell you different type of finance cost. Finance cost includes interest on debentures, interest on bank loan, bank charges on bank overdraft, discount on issue debentures. These are some examples of finance cost. Now, what is interest on debentures? Means the amount is raised through debentures and the company has to pay particular amount of interest to debentures every year, whether they are earning profit or not. It is charged against profit. होता ही है. Expense हो गया, finance cost क्या हो गया. Next is interest on bank loan. If we have taken the loan from bank, if the company has taken loan from bank, then the company has to pay some interest to bank. That is also finance cost. Bank charges on bank overdraft. If the company has taken extra amount from the bank on current account, then also the company has to pay tax or interest. Interest on issue debentures. If the debentures are issued at discount, means less than the nominal value. I am taking the example. Suppose nominal value of debenture is rupees 100. 10% debentures. Now, I want to tell you two things. First is 10%. 10% means interest on debentures. It is the rate of debentures. It is always shown in prior to the debentures. It is known as the name of the debenture. 10% debenture, 8% debenture, 12% debenture. The percentage indicate interest, rate of interest. If 10% debentures of nominal value 100 are issued for rupees 80 each, means nominal value is 100, they are issued for rupees 80. It means less than nominal value and the amount which is less is 20 rupees. This is known as discount on issue debentures and it is also finance cost. Next is depreciation and amortization expenses. I think depreciation you are very well aware. Depreciation is fall in value of assets due to wear and tear and passage of time. If there is any fall in value of fixed assets, then that will be entered in depreciation. We know the method of calculating depreciation. They are straight line method and diminishing balance method. And amortization means it is the fall in value of intangible assets. Intangible assets means goodwill, trademark, patent rights, copyright. So if the value of these intangible assets decreased, that will be entered in case of amortization expenses. Next is other expenses. Other expenses means the expenses which are incurred by the company and are not mentioned in any of these above expenses. They are to be entered in other expenses. Other expenses like carriage inward, carriage outward, they are the other expenses. After calculating all the expenses, total of all the expenses is written here. And for calculating profit, we have to deduct all the total expenses from total revenue. It comes as profit before tax. Means it is taxable income. On this amount, tax is paid by the company and after deducting tax from revenue before profit before tax, profit after tax can be calculated. From profit before tax, we have to deduct tax and we can calculate profit after tax. It is the amount which is actually earned by the company. Next point is users of financial statement. Users of financial statement. There are two type of users: internal users and external users. Internal users are the users which are within the company, within the organization, and external users are the users which are outside the organization, but they are directly or indirectly belongs to the organization. So in case of internal or users, we have different types, three types. First is owners. Owners are means shareholders. Second is management. And third is employees. First is owners or shareholders. They are the real owner of the company. Shareholders means equity shareholders, because equity shareholders are the real owner of the company. They are interested to know the financial statement. Reason being, they are the person who has invested money in the company. So they must know the earning capacity of the business. And next is management. Management is a group of people who works together for achieving predetermined objectives. Means in management, we include board of directors. Directors are also appointed by shareholders. They need financial statement so that they can prepare policies, make decisions, take decisions, make rules, and to avoid the deviations of the previous year. Now third is employees. Employees are the person who works in the organization. They need financial statement so that they can know about their future, whether they will get increments, bonus, etc. from the company. If the company is earning profit, then there are the chances of getting bonus and increment in salary. And vice versa, if there is no profit or there is loss, then there will be no chance of getting increments. In the same way, there are external users who are also interested in knowing the financial statement of the company. They are, first is bank and financial institutes. Second is creditors. Third is government. And fourth is SEBI. Bank and financial institutes are the person who has given loan to the company. They want to know financial statement of the company so that they can know about the earning capacity of the business, and they can know whether they will get their money back after a particular period of time, or they will get interest on regular base or not. If there is earning capacity or stable earning in the company, then there are chances of getting all these things. Creditors are the person who has given goods on credit to the company. They want to know about the financial statement of the company so that they can know about their earning capacity, and they can know about when they can get their money back or not. Next is government has to charge tax on profit of the company, so they want to know the profitability of the company. Next is Security Exchange Board of India. They are the real protector of the investors. They want to know the profitability of the company, financial statement of the company, so that they can verify that each and every investor is getting their bonus or premium at particular time, or they will be able to get their money back. Clear? Next point is limitations of financial statement. Limitations of financial statement. First is historical records. It means all the transactions which are recorded in financial statement, they are on historical value. But shareholders and other investors want to know present value of each and every transaction. Second is different accounting practices. Different accounting practices. It means different accountant can use different type of practices like calculation of depreciation. There are different methods of calculating depreciation. Different accountant or different companies can follow either of the method. So there is different in calculating the final result. Third is qualitative elements are ignored. It means while preparing financial statement, only quantitative elements are recorded. Qualitative elements like quality of management, quality of working conditions, they are totally ignored. Next is, fourth point is price level change ignored. Price of different items or different transactions are changed from past decades to now, but they are ignored, and they all the transactions are recorded in their historical value. So these are the limitations of financial statement. Now this chapter is completed. In next video we will start the new chapter. Till then, if you like my videos, then please subscribe and share. Thank you.